Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to look at Axon Enterprise Inc. stock, ticker AXON. It recently fell, I want to say it fell like 20% in one day. It's down about 30% off of its highs. As always, this is not individual investing advice, just how I analyze stocks. So these guys are mostly known for tasers, but they also have a bunch of new wearables, kind of software subscription type of deals for some of those products. And then they just made 2 acquisitions as well. So they're growing in other areas outside of the tasers. Seems like you're looking at more like monitoring type of things. You think like body cams and things like that, and then extensions of that type of stuff. So just in general, that's what they're into. I made a video on this back in, I think it was late 2023, maybe. I just peeked at it and kind of skimmed through it a little bit to see if, now I knew it didn't hit my buy price, which at that time was like $90 a share. It did get down to below that in 2022. So we weren't too far off. Might have been excuse me. Might have been 2024 when I made the video, but it was back in here sometime. And I was I was wondering how bearish I was going to be on it, and I really wasn't. It was just a question of valuation. So I didn't make too big of a fool of myself since the stock is up very big. I think I was very aware that was a possibility, but also very cautious about the stock in general. And so we're starting to see a little bit of that play out now with the stock price. I just saw an interview with the CEO and founder on Bloomberg a little while ago, and I had this video set up to make earlier in the week, and then I kind of put it off. But I think it's interesting enough to kind of take a peek at, and I might be able to just offer some, just my take on it, basically on the valuation especially. So we have if we just take, maybe this time frame that we have here, using adjusted earnings, I'm going to shorten it just a little. So they have like 33% growth per year if we're just going from the past 10 years on average. So like 30% annual compounded earnings growth for adjusted earnings. This past year has been a little bit slower with only 6% growth. And then we have these 2 acquisitions. I didn't go look and see how big they were. But overall, their valuation is like a $46 billion company. So I think it's worth, since it's on its way down, I know nobody's asked me about it yet, but I know they will. So I'm going to get ahead of my chalkboard list back there a little bit with this one, because I thought it was worth kind of sharing my thoughts about. So we have a PE of 94, which is very high. But if they can grow earnings at 30% a year for the next like 10 years, then it would probably justify that. I would say more than justify a 90 PE, because you're going to reduce that by half within 2 to 3 years, and you're going to, if you're doing it 30% a year, you're going to do that 4 times or whatever by the time you get to the end of the 10-year period, maybe more. So that would bring that PE way down. But that's a very tall task for a $40 billion company or $45 billion company to do. So when I do these sorts of estimates, I really limit myself to a 20% earnings growth rate over the longer term, which is usually at least 10 years. Because I know how hard it is to do better than that. Now, granted, they did have good earnings, like better earnings growth than that the past 10 years, which actually often makes it harder to do it for another 10 years. But that kind of landed in the bottom of their earnings here. Like if you go back to maybe like 2013, now we're down to 26% growth already, and that's counting these years. So 27% per year. But we have years where it's less than that. So in terms of like collected earnings, it would be more like 20% just over this time period. So when you take into account kind of the changing landscape, the new acquisitions, kind of the adjustments they're going to have to make over time, there's really not enough forward visibility to really look forward 10 years on a business like this. So a 20% to me is a very reasonable maximum to use in terms of expected long-term earnings growth. Like, to me, that's plenty generous. You can see that this year was slower than that, and the next couple of years are expected to be right at that. So I think that's plenty generous. Now, in the conversation with the CEO, he pointed out that one of the reasons he thought the stock sold off was because their GAAP earnings or basic earnings fell a little bit. So he said that was because of employee-based compensation that was tied to operating earnings growth or something close to that. So basically, the better the company does, the more stock-based compensation the employees get, and that reduces this earnings number. I haven't really processed that and how I think about what sort of role that might play for me personally. I mean, if you use that, the PE is like 300 or something. So, but worth pointing out, I'm going to be more generous than that. I'm going to take the adjusted earnings at face value for now, and I'm going to assume that they can grow those at 20% a year for the next at least 10 years. All right. So if we start with this $6.29 a share, I'm going to use a time until payback method, which is pretty familiar to people here. So the idea is, if you bought this business, if you bought the whole business, how long would it take the business to pay you back the amount of money that you paid for it via its earnings and earnings growth? So if you pay $100 for the business, how long does it take to earn $100 in earnings over time? And I'm going to assume a 20% growth rate. And I actually used $6.33 because I did this a couple days ago. So that's actually come down a little bit. I can change that. So that's for this year. Analysts kind of dialed this back a little bit. And so that'll change things slightly. So you start with $6 in earnings, $6.29 in earnings. And if you look at the stock price, it's still at like 600 or close to a little under 600. I guess I have it here, 609. Yeah. So what we want to do is get an earnings yield from this, right? So this is a PE almost of 100. It's just a little under 100. So you can tell that the earnings yield is about 1%. So the earnings yield is just the PE ratio inverted, right? So if you take these two numbers, like a PE ratio would be 609 divided by 6.29, right? The stock price over the earnings. If you invert that and you divide 6.29 by $609, then you get the earnings yield expressed as a percentage. So in this case, the earnings yield is only 1%, but it is going to grow at 20% a year, and I also pull forward the first year's growth. So the way to think about this is, if you bought the whole business for $100 and you give yourself 20% growth that first year, you would earn $1.24 on your $100 purchase of the business. And you get to keep that. And then the next year, that grows 20%, and you earn $1.49 that year, and you get to keep that. And then the next year, that grows to $1.78, and then $2.14, and then $2.57. And each year, you get to keep that money. You want to know how long it's going to take you to equal $100 or surpass $100. So that's what this spreadsheet's set up to do. And the answer to that is 16 years. So 16 years is a very long time to take to earn your money back on a business, especially one that is dealing ultimately in technology. Also, I would say government policy, even if it's municipal government as much as national. And so for me, on valuation basis, that would be a sell still. It's just too expensive. The market isn't a ton cheaper than this. It's around 14 years, I think. It's been a while since I'd done the actual calculations, but it was right in that 14, 15 year time frame. So it's expensive, but this stock's even more expensive than the S&P 500. So to me, I would be probably selling based on valuation, unless there was some portion of it I just wanted to hold for the long term, or some very, like me. Although I think if you just bought this within the past year, you're probably barely above water. So yeah, I mean, maybe you have a little bit of profit. I mean, if you have to wait to get to long-term capital gains or whatever, I could see that potentially. But for the most part, this would get a sell rating for me based on valuation. When you toss into that the acquisitions that are going to add risk, potential, they have had, now granted the business has changed, but you know, they have had times where earnings fell 100% during the Great Recession. That shows at least some evidence of economic sensitivity. If you think of if municipal governments or whatever are one of your major sources of income, and I don't know what ratio individual people are, but it would still go the same way. These sorts of monitoring devices and things are discretionary in most cases. So, although I suppose you can make the case that if crime goes up, then you have more of an incentive to do. But to me, I think there's going to be economic sensitivity with this business, and there is evidence in the past that there has been some. So that's an additional risk, right? So when you have high valuation, when you have potentially a recession or something like that coming along, when you're doing acquisitions in order to keep growing at the rate the market expects you to grow at, that all might be okay, but it raises the risk that it won't, or you'll go through a period where it won't. And when you have 100 PE or close to it, the chances are that the stock could fall a lot is quite high. So I'm not sure. So it's down 30% now off of, let me see what the peak was, almost $900. To me, this is a stock that could lose 85% pretty easily in a recession off the peak. So there's a lot of downside risk here. And to me, it makes sense to take profits, especially if you're in long-term capital gains and you were buying back here. I know this stock has done fantastic for investors over the past decade. Even with the sell-off, it's up 3,000%. So, but this is a setup where, and you can almost see a head and shoulders, like you have a shoulder and a head. So I don't know if you want to wait for another shoulder or not, but it's starting to look like a setup where we're going to get some sort of re-rating is the most likely outcome, I think, for the stock. So I feel pretty comfortable putting just a basic sell or trim rating on this one. And then we'll see what happens. Now, the price I would be willing to take a look at buying it is about $158 a share. That sounds like a long way to go, but let's see. Wasn't quite there here. You have to go back 3 years to get down there, below there, like significant below in that case. Yeah, so right about going into 2022 was about the last time it was down there. At that point, I think it starts to get interesting at least, and I would start to look at it more closely. I'm not sure. I mean, if earnings were just getting devastated and falling off a cliff, I might wait for a bottom, but I would be interested in owning the stock because I think it's a solid business. It's just that the market isn't pricing it any cyclicality, and it's pricing in 25% growth or something like that each year for the next decade. And I think that's probably too optimistic. So the odds of being able to get it, and if it overdoes it to the downside on the way down, which can definitely happen when you have a stock that is this far, that had this big of a peak. Like once people start freaking out and short sellers start coming in and piling in, the rush for the exits, which we're actually starting to see already, can be big. And if it swooshes really down, this might be one I'm willing to come and step in and buy a little bit of at the right price. But at that $158 level, that assumes that they're earning this and growing 20%, which is still pretty optimistic, I think. But at least there's a little bit of margin of safety there. I would be willing to maybe come in and take a nibble on this one. I'm not sure what the debt looks like. It doesn't look like they really have any, as far as I can tell. I don't know if the new acquisitions are part of that or not. I haven't looked at the details of them. But yeah, under 158, that's where, using these same assumptions, it would take a little under 10 years to earn your money back, which to me is like a good, reasonable spot to aim. Like, you're probably getting a good deal as long as you have some decent visibility on future earnings, or reason to believe that they can do these type. Even if there's a downturn, maybe they'll recover within a couple of years, and so they'll have a couple of years of really fast growth off the bottom, and then they'll get back to kind of normal growth. That's kind of what that buy price is. All right. I have weekly picks over on Patreon for $25 a month. I also have a free tier over there where I post a lot of videos. Check those out. If you found this useful, hit the like and subscribe button, and I'll see everybody later.